I know how we all feel about taxes, but what if I tell you I can help simplify the complicated world of taxation for all you NRIs out there? Yes, you heard it right. Welcome to Groww NRI and I'm Karunya. In this video, we'll discuss if NRIs need to file ITR in India. Did you know that NRIs might find themselves entangled in a web of tax implications spanning multiple jurisdictions, often leading to unexpected financial consequences? So if you are an NRI, stay tuned. But before we proceed, let me tell you what an ITR is. An income tax return or ITR is a form that an individual submits to the Income Tax Department of India to file information about their income and taxes payable during that year. Information filed in an ITR should be applicable for a particular financial year between April 1st and March 31st of the next year. Moving on. Who is an NRI? A non-residential Indian resides in India for less than 182 days in a financial year. NRIs can refer to those working abroad holding an Indian citizenship, gone out of India or staying abroad for business-related activities or even for vocational purposes. If an individual has relocated from India or is residing abroad for any other purpose, suggesting an intention to stay outside India for an unspecified duration of time. Remember, NRIs are subject to a distinct set of tax regulations compared to Indian residents. The income generated outside India remains untaxed in India, while income earned within the country is liable to taxation. A resident taxpayer is one who resides in India for a minimum of 182 days in a financial year. It's also referred to an individual who lived in India for at least 365 days in the immediately preceding 4 years and for a minimum of 60 days in the current financial year. If any income you earned is accrued or received in India, for example, your salary is paid for services you provide here in India, that shall be taxed in India irrespective of the place where you're receiving the income. Now, if you earn from a property situated in India, a tenant paying rent to an NRI owner must ensure to deduct TDS at the rate of 30% when making the payment. The income can be received either into an account in India or into the NRI's account in their current country of residence. Next, if you receive interest income from fixed deposits and savings account that are held in Indian bank accounts, interest on NRE and FCNR accounts is tax-free. Interest on NRO accounts, however, is taxable. Income earned from a business controlled or set up in India. Any capital gain on the transfer of capital assets situated in India, capital gains on investments in Indian shares and securities are also taxable in India. If you sell a property and have a long-term capital gain, the buyer must deduct a TDS of 20%. NRIs investing in specific Indian assets are subject to a 20% tax on the income earned. If this special investment income is the sole income for the NRI during the financial year and TDS has also been deducted, filing an income tax is not necessary for such individuals. Before we go any further, let me simplify some commonly used jargon when it comes to taxes. First is income accrued in India, which refers to revenue that has been earned or generated but not yet received in cash. In other words, it represents income that is due to be received in the future in India as a result of providing goods or services in India or abroad. Second is accrued income, and it's recognized in the accounting records when it is earned, regardless of when it is actually received. On the other hand, income earned in India means receiving money into your Indian bank account in exchange for providing services or business activities in India or in a foreign country. Now, let's say you provide services to a foreign company in January 2024. But you receive the payment against that in India in April 2024. In that case, the income generated is taxable in the financial year 2023-24 when it was accrued, even though it was received in the following financial year. If you provided service for an Indian company but received the payment in a foreign country, it is still taxable in India as the income is received or accrued here in India. Then there are dividends declared by a foreign company, rental income from residential property located outside India, or gains from the sale of foreign investments, which are recognized as earned outside India. Such dividends, rental income, or even sale proceeds of investment deposited in any foreign bank account will be seen as income earned, accrued, and received outside India. Therefore, it will not be taxable in India. Now, if you're confused between global income and Indian sourced income, let me clear out this confusion for you. If you're an Indian resident, your global income is taxable in India. This income may have been earned or received outside, but it would be taxed in India. If this income is also taxable in another country, then you can take the benefit of DTAA, which is Double Tax Avoidance Agreement. As per the Income Tax Act 1961, NRIs are mandated to file an ITR in India only if their total annual income in India exceeds 2.5 lakh rupees as per the existing tax regime, which is the Finance Act 2023. Rupees 3 lakhs as per the new tax regime, section 115 BAC of the Income Tax Act 1961. If you opt for the existing regime, the total income as defined earlier is the income before considering the following. Number 1, deductions like premiums towards life insurance policies, tuition fees, investments in ELSS, which is equity linked savings schemes under section 80C, Mediclaim under section 80D, and donations under section 80G. Number 2, specified exemptions can include long-term capital gains from assets like new residential houses, investment into specified bonds, etc., when they are reinvested. Even when your income does not exceed the mentioned income threshold in a given financial year, which is April to March of next year, you are required to file an income tax return as an NRI if you've deposited more than 50 lakh rupees in a savings bank account in India, or if you've deposited more than 1 crore rupees in a current account with a bank or cooperative society in India. Tax deducted at source or TDS, or tax collected at source TCS of more than 25,000. If you have spent more than 2 lakh rupees on travel expenses from India, whether for yourself or someone else traveling abroad. As an NRI, if you skip filing an ITR when not mandatory, remember filing an ITR can be helpful to maintain consistency in your tax return filing records. You can claim a foreign tax credit in your country of residence as per the applicable tax laws of the residing country. For example, take Priya, who's an NRI living in Australia, who earns rental income from her property in India. Now, last year, her Indian income was below the taxable threshold, so she did not file an ITR. When she applied for a mortgage in Australia, the bank required her tax return history, causing delays and complications. Now, had Priya filed her ITR, she could have easily showcased her financial consistency, speeding up the entire mortgage process. Long-term capital gains derived from the sale or transfer of foreign assets do not qualify for indexation benefits, nor are deductions permitted under Section 80C. However, an exemption can be claimed on the profit under Section 115F if the profit is reinvested into an Indian company's shares, banks, and Indian public companies as deposits and government securities. As per Section 115E of the Income Tax Act, investment income is subject to a flat tax of 20%, while long-term capital gain is taxed at a flat rate of 10%. These rates apply uniformly, and there is no provision for an exemption threshold below which income is not taxed. Section 115D applies to the calculation of tax. For non-resident Indians, this section does not permit the calculation of investment income. No tax deduction is allowed on the gross total income, which comprises solely earnings from long-term capital gains and investments in case of an NRI. To know about the TDS by tax deductors as an NRI, you can refer to Form 26AS. This showcases details such as the deductor's name, their tax deduction account number, which is TAN number, the amount paid or credited, the deducted tax amount, and the period during which the deduction occurred. If an NRI received any income on which tax has been collected at source, Form 26AS for NRIs will present the relevant information comprising the name and TAN of the entity or individual collecting the tax, the amount paid or debited, the tax collected, and the respective period. Just make sure you have these documents ready before filing an ITR. Your PAN card, passport, Form 16, bank account details, bank statements, property documents, rent receipts, investment statements, paid tax details, your foreign income details as well will be required. Finally, the most important part, the steps to help you file an ITR. You can proceed with income tax e-filing online through the Income Tax Department's official website. Now, for this, you can also seek assistance from a tax consultant. ITR forms for NRIs vary based on their income sources. ITR 2 is applicable for all types of incomes except business income. NRIs can use ITR 3 for business income. Fill in your accurate information with respect to your income, deductions, and taxes paid. NRIs can claim deductions under sections like 80C, 80D, and 80G. Certain incomes such as interest on FCNR or NRE accounts, etc., are exempt from taxation. Form 26AS provides details of the TDS and other income sources. If your income is taxable both in India and the residing country, you may be eligible for some relief under DTAA between the two countries. File the necessary forms to claim this relief and avoid double taxation. Verify your income tax e-filing return using your Aadhaar OTP or your EVC, which is electronic verification code, and then submit it. Now, what happens if you fail to file ITR when mandatory? What are the penalties that you're looking at? If your annual income in India exceeds 5 lakh rupees, a late fee of up to 5,000 rupees can be imposed, which may increase to 10,000 rupees if the ITR is filed after the deadline. Next is interest payment. As per section 234A, taxpayers who fail to file ITR within the prescribed due dates are required to pay an interest rate of 1% per month on the unpaid tax amount. There's penalty under section 721H. Apart from the late filing penalty specified in section 234E, individuals failing to submit TCS or TDS statements by the deadline face a penalty ranging anywhere from 10,000 rupees to 1 lakh rupees. The penalty under section 234E accrues at a rate of 200 rupees per day until the TCS or TDS is paid. And if you have more questions related to NRI taxation in India, do send us in the comments below. Alright, let's quickly summarize what we've discussed in the video today. An ITR is a form that an individual submits to the Income Tax Department of India to file information about their income and taxes payable during that year. A non-residential Indian or NRI resides in India for less than 182 days in a financial year. Income generated outside India remains untaxed here in India, while income earned within the country is liable to taxation. An NRI has to pay taxes if they receive a salary for providing services here in India, capital gains through investments made in India, and earn from a property that is located in India. Remember, escaping mandatory tax filings can lead to severe implications like penalties. It is always advised to consult a tax professional if you lack in-depth knowledge in this matter. Remember, this video is only for educational purposes. Any information that we've shared in the video is not an endorsement or investment advice. And with that, it's a wrap on today's video. Don't forget to like, subscribe, and share for more informative content. So see you in the next video. Until then, keep growing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.